Welcome back to the Deep Dive. Today, we're cutting through the noise on the Ralph Lauren Corporation, specifically their second quarter fiscal 2026 results. They reported back on November 6th.
And the numbers were, well, quite something.
Right. The big question that jumped out immediately is how? How does a global luxury brand pull off double-digit growth literally everywhere, across every geography, and then raise their full-year outlook? All while, the CEO is calling the operating environment highly dynamic.
Which is usually code for things are tough.
Exactly. So that's our mission today. We need to figure out what they're doing right, what's allowing them to speed up when others seem to be, tapping the brakes.
Okay, let's get into it.
Okay, so let's dive right into the core metrics, the big picture stuff. Net revenue shot up 17% on a reported basis.
Yeah, but the operational number, the constant currency one, is probably more telling.
Right, and that was up 14%.
Which is still very strong. Constant currency gives you that clearer picture, takes out the exchange rate swings.
Shows the underlying health.
And 14% revenue growth is significant, absolutely. But, the real story, I think, is how they turned that into profit.
Oh, absolutely. The bottom line, the earnings per share numbers, they're almost, hard to believe. Adjusted diluted EPS hit $3.79.
Which is up, what, almost 50%?
Yeah, a massive 49% jump compared to the $2.54 they did same time last year.
49% EPS growth. That tells you everything.
It's not just selling more stuff.
No, it's selling better.
Yeah.
More profitably.
Exactly.
And it's fascinating because this performance didn't just, meet expectations, it blew past them. And crucially, like you said, the growth was margin expanding, their gross profit margin, up 100 basis points, hit 68.0%.
Oh, hold on. Let's just quickly define basis points for everyone. We mean hundredths of a percent.
All right.
So 100 basis points is a full 1% improvement in gross margin. That's the money left after making the product, before overhead.
In this retail climate, getting that kind of margin expansion, that's a huge signal.
Signal of what, exactly? Pricing power.
It is the ultimate signal of pricing power, yeah. It means this isn't just discount-fueled volume. It's driven by strong demand at full price. And the CEO links this back to their strategy, the next great chapter, Drive Plan.
Right.
Specifically reinforcing their position as an inclusive luxury lifestyle brand.
Which sounds a bit like corporate speak, but what does it mean in practice?
It basically means we're aiming higher, more premium, but we still want a broad appeal. We want people to feel like they can belong.
Okay, so that's the strategy framework. The report, as we said, emphasized double-digit growth everywhere, all geographies.
Which is pretty remarkable.
To keep that luxury feel, you need that global resonance. So which regions were really, the stars? Where was the most profitable growth coming from?
Well, overall, the direct-to-consumer business globally looked very healthy. Comp store sales up 13%.
Okay.
But if you slice it geographically, Asia is clearly the acceleration engine right now.
That's strong as Asia.
Revenue up 17.2% reported, or 16.3% in constant currency.
17% is huge. For a brand this established, what was driving that, specifically in Asia?
China. China was the powerhouse within Asia. Revenue growth there was more than 30%.
Wow. Over 30%. Is that a new trend?
It continues what we saw last quarter, so it looks like a sustained surge. They're really connecting there.
Okay, and is that 30% mostly new stores? Or are they nailing the digital side in Asia? Because Asia often leads in digital, right?
Yeah, definitely nailing digital. That seems to be the theme. Digital commerce in Asia surged an incredible 36%.
36%.
Yeah. So that's a key takeaway. It's not just about building more stores, though they did that too. Brick and mortar was up 14%.
Still strong.
Still strong, but digital is just outpacing it significantly. They're capturing that online shopper.
Fascinating. Okay, so Asia, volume driver, digital star. How did Europe stack up?
Europe offered a different kind of strength, I'd say. Revenue grew 15% in constant currency. Excellent growth.
Solid.
Very solid. But the real story in Europe, margins. Profitability. Europe's operating margin was the highest across all segments, 29.4%.
29.4%. And how much did that improve?
It was up 360 basis points. That's 3.6 percentage points better than last year.
Wow. So Europe is the profit engine.
Right now, yeah. It's their most profitable geography.
Okay, so Asia for acceleration, Europe for margin. What about the home market, North America?
North America showed really robust, kind of balanced growth. Revenue up 13%. Comp store sales also up 13% overall.
13% comp is strong.
It is. And what's healthy about North America is how that growth was spread. Digital was up 15%, and physical stores, brick and mortar, up 12%.
Okay, that's interesting. Almost an even split,
Very even.
which suggests maybe that they aren't just relying on e-commerce to bail out physical stores.
Exactly. Both channels are firing, both contributing almost equally to that double-digit comp growth.
It kind of suggests that whole key city ecosystem idea they talk about, it's actually working, especially where their brand is most established.
Seems like it.
And that operational success, it has to tie back to the strategy, right? Those pillars you mentioned.
Absolutely. This isn't happening by accident. It's a next great chapter, drive strategy playing out.
Okay, let's break those down. Priority 1, elevate and energize the brand. How do they actually measure elevation? It can't just be vibes.
No, they look at concrete things. Two main areas, getting new customers directly and cultural relevance.
Okay, new customers.
The data showed they added 1.5 million new consumers just in their direct-to-consumer channels this quarter alone.
1.5 million, that's tangible evidence.
It is. And then second, the cultural relevance piece. They talk about powerful, authentic consumer engagement.
Which translates to...
Well, high visibility through those iconic sports sponsorships. Think Wimbledon, the U.S. Open, the Ryder Cup. That's ongoing.
Right, those reinforce that sort of aspirational, classic brand image.
Yeah.
Very Ralph Lauren.
Textbook, yeah. But the sources also pointed to the more modern cultural stuff, the kind of celebrity-style moments that generate buzz online.
Ah, okay. Like what?
Exactly. They specifically mention leveraging big moments. Things related to the Taylor Swift and Travis Kelce engagement news.
Ah, right. Huge buzz there.
And also the wedding of Selena Gomez and Benny Blanco, being seen in those contexts.
So it's not just dressing celebrities, it's making sure those moments matter culturally and hoping that translates to people wanting the product.
Seems to be the goal, mixing that heritage feel with very current pop culture relevance.
Makes sense. Okay, priority 2, drive the core and expand for more. Product strategy, basically.
Exactly. It addresses the what are they selling question.
So are they just selling mountains of polo shirts?
Well, the core business did grow mid-teens, so yes, the classics are doing very well.
Okay.
But smartly, they're focusing hard on expansion categories, things that tend to have higher price points, more growth potential.
Like what?
Women's apparel, outerwear, handbags. Those categories grew strong double digits, actually grew faster than the company average overall.
Okay, so shifting the mix slightly towards higher value items.
Seems like it. And this priority also covers innovation. There was a key detail about a tool called Ask Ralph.
Ask Ralph. Sounds like an AI thing.
It is. It's a new AI-powered styling tool built into their website and app.
Okay, what does it actually do for the customer? Is it useful?
It's basically like having a virtual stylist.
Okay.
It uses generative AI to give you personalized product recommendations, suggests full outfits, maybe based on stuff you tell it, or even pictures you upload.
Huh. So it tries to replicate that high-touch personal shopper experience, but online.
Exactly. It takes the online experience beyond just scrolling through products. It connects tech directly to that inclusive luxury idea, making styling advice accessible.
That's a clever strategic link, investing in AI to boost the brand's luxury feel. Okay, but let's circle back to the core idea of elevation. All this focus on luxury perceptions, sponsorships, higher price categories. Did it actually let them charge more, or did they still need promotions?
That's the kicker. They didn't need the promotions as much. This might be the most impressive number in the whole report, actually.
Okay.
Average unit retail, AUR. It increased 12% across their direct-to-consumer network.
12% AUR increase. So the average price someone paid for an item, up 12%.
Yep.
That's a huge jump. Passing inflation directly to the consumer and then some.
It's clear proof of pricing power. And the report emphasizes this came from strong full-price selling trends and lower-than-planned promotions.
Meaning people were buying it without the discount.
Exactly. That is the definition of successful brand elevation in action. The customer sees the value and is willing to pay for it.
Okay. And the final priority, priority 3, win in key cities. That ties back to the physical stores, right?
Right. Connecting the physical footprint to the overall strategy, they kept expanding those key city ecosystems.
How many new stores?
Opened 38 new locations, both their own stores and partner stores this quarter. And they're focusing on premium spots. Major openings in Munich, Germany, and Hangzhou in China.
So doubling down on visibility in top markets.
And they even bought their big store on Newbury Street in Boston. That signals a real long-term commitment to having a presence in those key high-traffic luxury areas.
Okay, so all these strategic moves, the store openings, the tech investments, they need a solid financial base. So
Absolutely.
let's look at that. Connecting this back to the big picture. How healthy is the balance sheet supporting all this activity?
They described it as a healthy balance sheet positioning, which seems fair. They ended the quarter with $1.6 billion in cash and short-term investments,
That's decent cushion.
a very decent cushion, and they're actively returning cash to shareholders, too. About $420 million given back year to date through dividends and share buybacks.
Okay. And going back to segment one, that profitability, the margin expansion,
Yeah,
that's really funding this, right?
yeah.
Can we just quickly recap the drivers of that incredible 68% gross margin?
Yeah, absolutely. It boils down to three main things, all reflecting the strategy working. One, that high AUR growth. We talked about the 12% price increase sticking.
Pricing power.
Two, a favorable product mix, selling more of those higher margin items like handbags and outerwear.
Okay.
And three, surprisingly perhaps, lower cotton costs actually helped. That offset some other pressures like tariffs and higher manufacturing costs.
Impressive financial discipline all around.
Hmm.
But now looking ahead, they raised their outlook for the full year, which is great.
Fantastic news, yeah.
But the language still sounds cautious, tempered. Where's that caution coming from if things are going so well?
Right. So they did raise the fiscal 2026 outlook, now expecting revenue up 5% to 7% in constant currency.
Which is up from before.
Yes. And operating margin expected to expand 60 to 80 basis points, again, better than previously guided. That reflects Q1 and Q2 being stronger than they initially thought.
Yeah.
But the caution is real, and it's focused on the second half of the fiscal year.
Okay, so if their own execution is strong, what external factors are making them cautious? What are they worried about?
They're pretty specific in the source material about the global environment. They cite ongoing geopolitical issues, the Russia-Ukraine war, the Israel-Hamas conflict.
They did macro risks.
Standard but significant. And importantly, they also flagged the recent hostilities and attacks on shipping in the Red Sea.
The Red Sea, that's crucial because that hits supply chains directly, right? Especially for goods made in Asia heading to Europe and North America.
Exactly. It means higher shipping costs, longer transit times, more uncertainty.
Okay.
So you combine that specific risk with just ongoing general inflationary pressures, plus foreign currency swings, remember, they sell everywhere, and you see why they're cautious.
So their strategy is working, they're resilient, but they're not naive about the world outside.
Precisely. Resilience, not complacency. That seems to be the message.
Yeah.
Hashtag tag outro.
So wrapping this up, what does this deep dive really tell you, our listener? It shows Ralph Lauren executing a really specific and frankly difficult strategy. They're achieving genuine premium pricing power. That 12% AUR growth is phenomenal proof, while also achieving real global reach. With double-digit growth everywhere, that's not luck.
No.
It seems executed through very focused investments. High-leverage things like the Ask Ralph AI tool and those carefully chosen culture-shaping brand moments.
Yeah, the core takeaway for me is that their pivot towards a more elevated direct-to-consumer model, it's clearly working now. It's translating into financial results, into discipline. They're kind of showing the blueprint for how you capture quality, margin-rich growth, even when you know there are serious global headwinds coming at you, like supply chain issues and geopolitical uncertainty.
Okay, before we finish, here's something provocative for you to think about. We've talked all about their success, the strategy, the reduced promotions, yet the source material also shows their inventory levels are actually up 12% compared to last year. Ended the quarter at $1.3 billion in inventory.
Interesting detail.
So the question is, given their own outlook warns about Red Sea disruptions and supply chain risks, is that 12% inventory increase a smart, proactive move? Are they deliberately holding more stock to buffer against those risks, making sure they have product for key seasons? Or could it potentially signal an underlying challenge? Maybe trouble perfectly balancing supply with actual demand, especially looking ahead to that second half they're so cautious about.
Preparation versus potential overstock.
Exactly.
Yeah.
That tension is something for you to mull over as you watch how Ralph Lauren navigates the coming months.